Hello everybody, today we're going to be discussing Strife from Strategy because I believe it is the greatest fixed income product ever conceived. I truly believe this is the death of legacy fixed income. Strategy's Series A 10% Perpetual Preferred is not just an income instrument, it is a monetary architecture experiment. It is fusing elements of high yield credits, perpetual equity, and hard money collateral in a configuration that simply does not exist anywhere else in the fixed income ecosystem. Let's start with the headline, a 10% cash coupon, cumulative, taxed as a qualified dividend, which means 0%, 15%, or 20% federal, not 37% like your ordinary bonds. This is critical. In post-tax terms, Strife can deliver up to 300 basis points more net yield than equivalently priced junk bonds depending on investor bracket. And this is paid from a company that holds over 500,000 Bitcoin, well over 500,000 Bitcoin, not from mattress sales or a mid-cap real estate investment trust choking on refinancing risk. This is yield backed by the hardest asset in history. The term is perpetual and non-callable. This is where it gets spicy. Strife is non-callable and perpetual. There is zero reinvestment risk. You get your 10% cash yield forever. There's no maturity wall, no forced redemption. This flips the risk asymmetry for income allocators. With Strife, you're not racing against time. You're collecting yield at the edge of monetary physics. If Strategy misses a payment, the coupon escalates by 1% per year, compounding up to 18%. This is a built-in penal yield accelerant. What this really means is that the board is now financially disincentivized to miss a coupon. Every deferral increases their cost of capital, and they personally own this instrument. The board is playing Russian roulette with a hair trigger if they defer. And for you, you're essentially holding a punitive time bomb that increases in power the more they hesitate. Strife sits below $8.2 billion in senior and convertible debt, but above the equity stack. It is preferred equity, but with strong liquidation seniority and massive asset coverage, and we'll talk about that soon. Effectively, you're in a fortified mezzanine position, yielding 10% with equity-like upside if Bitcoin explodes, and credit-style downside protection if it crashes. Strife also includes a fundamental change put clause, which is triggered if Strategy sells its Bitcoin treasury or undergoes hostile recapitalization, which is essentially a nuclear option clause. It lets you put your shares back for par plus accrued. It means if they violate the Bitcoin thesis, they don't just lose your credibility, they lose your capital. Now here is the silent killer advantage of owning Strife. Bonds are taxed as ordinary income. Strife's dividends are QDI, which under US tax code means most investors are looking at 15% or less effective rates. Run the math. For an investor in the 15% bracket, the after-tax yield is nearly 10% versus 6.4% for the same nominal on a junk bond. You're getting the high yield cash flow without getting murdered by Uncle Sam. Now let's pull back the curtain and look at the collateral structure, because this is where Strife transitions from an interesting yield play to a macroeconomic anomaly. As of now, Strategy holds 568,840 Bitcoin, worth $59.2 billion at a 104K spot price. That's not the total assets, that's just the raw Bitcoin on the balance sheet. No company in history has ever had a digital monetary base this large and this transparent. Against that sits $8.19 billion in convertible and unsecured debt, and $850 million in Strife par value, which is 8.5 million shares times $100. That's $9.04 billion in senior obligations. You now have a single collateral system where Bitcoin must cover $9.04 billion in senior liabilities. So let's do the math. If you look at the Strife only coverage, 59.2 billion divided by the 850 million, that's 70x par. The total senior coverage, 59.2 billion divided by the 9.04 billion is 6.5x. So 70x coverage for the preferred alone, 6.5x total coverage even when accounting for the entire senior capital stack. To be clear, that is equity style upside protection, fixed income instrument. This obliterates the typical credit model. CCC rated bonds often have less than 1.5x coverage and their collateral depreciates with every missed quarter. Strife's collateral appreciates by design. Let's stress test it. What happens if Bitcoin crashes? $9.04 billion divided by 568,840 Bitcoin equals 15,900 per Bitcoin. That's the break-even point. So Bitcoin could fall 85% from current levels, and you'd still have 1x asset coverage across all senior liabilities. No high-yield bond offers that level of resilience. None. Median recovery in default for junk debt is about 40%. Strife maintains full principal protection down to a 5-figure Bitcoin apocalypse. What this slide proves is simple, folks. Strife is the first credit instrument in history backed by an asset that's structurally deflationary, globally liquid, unconfiscatable, and appreciating. It has the coverage ratios of a sovereign and the yield of a distressed real estate investment trust, but none of the operational drag. You're essentially betting that Bitcoin won't die. And if you believe that, Strife is the most over-collateralized fixed income weapon in the entire world. The most dangerous phase in finance is it screens as junk. Because when institutions see unrated, they assume unworthy. But Strife is the mispricing of the decade, and that mispricing starts with the spread. So have a look at this table, folks. What this table actually means is that Strife is yielding 400 basis points over the high yield index and 700 plus basis points over treasuries. After taxes, Strife offers 50 to 100% higher real income than its comparables. No duration risk, no reinvestment risk, no curve risk, and unlike treasuries or junk bonds, its collateral base grows over time. Strife isn't just mispriced, it's operating outside the conventional bond model entirely. Let's get real, why is Strife yielding this? Number one, it's unrated. If Moody's or Fitch put a rating on this, it would fall somewhere between B, and A, but the lack of rating makes it screen as junk in most models. Number two, Bitcoin exposure. Institutional allocators see Bitcoin linked and they flinch. They assume equity level volatility even though holders of Strife don't take Bitcoin mark-to-market hits. Strategy does. New structure equals legacy friction. This product is novel. It doesn't cleanly fit into bond indexes, preferred share benchmarks, or LDI allocation buckets yet. This is what creates the arbitrage. The optical risk is higher than the real risk, and the actual reward is dramatically underpriced. Strife is not just a high-yield oddity, it's the Trojan horse that's about to invade and gut the legacy fixed income fortress. Let's walk through how and why Strife starts vacuuming up capital flows in 4 stages. A, there's a structural yield advantage. In a world where most junk bonds yield 5 to 8%, Strife offers a 10% base case and up to 18% if payments are skipped. Even if Bitcoin flatlines for a decade, Strife still out-yields nearly every bond in the index, trades at a discount, offers tax-advantaged income, rides no yield curve risk whatsoever. Strife doesn't need Bitcoin to go to $1 million to win. It wins even in a flat or mildly bullish regime and explodes in a halving-driven supply shock cycle. Here's what no fixed income manager is pricing in. Strife's risk decreasing over time. Why? Because strategy keeps buying Bitcoin every single week. With every ATM equity issuance, convertible redemption, and now even Strife sale, the company adds to its Bitcoin stack. That means the collateral base expands, the coverage ratios expand, and the default probability shrinks. This is the inverse of a bond. Normally, as debt grows, credit risk increases. With Strife, the debt stays flat, but Bitcoin grows, reducing risk structurally. It is quite literally a deflationary credit profile. C, regime shifts in the LDI and insurance space. Strife isn't just for hedge funds and macro traders. It solves regulatory headaches in the deepest pools of institutional capital. Think pension funds. Strife sits into preferred share buckets, which are often unconstrained by fixed income allocation caps. Think insurance general accounts. Strife functions as a yielding surrogate for Bitcoin exposure without requiring them to hold spot Bitcoin directly on the balance sheet. This means Strife becomes a tool for improving portfolio returns, hedging inflation with Bitcoin, enhancing solvency capital under NAIC guidelines. You won't see this today, but over the next 24 to 36 months, LDI mandates and risk-based capital models will adjust, and Strife will start to flow into multi-billion-dollar fixed income sleeves. D, liquidity and index eligibility momentum. Today, Strife is trading with tighter spreads than many double B credits. But once the float hits $1 billion and it becomes index eligible for the PFF, iShares Preferred and Income Securities ETF, or PGF or JPI. Once Strife gets indexed, it triggers mandated inflows. And those inflows tighten spreads. They drive the price up, they reduce yield, creating the reflexive loop. Strife is a ticking capital magnet. It wins because it pays more than bonds. It's taxed less than bonds. It has more coverage than bonds, and it improves structurally over time while bonds decay. Most credit managers don't see it yet because their models are broken. But as capital constraints, yield mandates, and solvency regimes catch up to this new asset class, Strife is going to eat everything that's still pretending fixed income means safe. And the best part is that it doesn't even need to win. It just needs the bond market to keep losing, which is practically a guarantee at this stage of fiat decay. At this point, you might be thinking, okay, Strife is structurally superior, but how big can this get? The answer is colossal. Not because of hype, but because the fixed income ecosystem is desperate, dying, and yield starved. And Strife is the only clean hit left on the street. Let's dissect the inflow math with sober eyes and predator instinct. All right, let's look at these numbers because this is going to be fun. So let's look at the preferred share ETFs, 3 billion on the bottom. So that'd be 8% of 38 billion as an allocation assumption. US HY mutual funds, 3.4 billion. That's assuming 1% of 341 billion. Insurance general accounts, 5.6 billion. That'd be 2% of 280 billion as an allocation assumption. Global family offices, 0.25% of 4.7 trillion. That's a hefty amount as well. So that's a projected Strife asset under management by 2029 of $24 billion. That's phenomenal. That's incredible. These aren't wild numbers. They're conservative fractional reallocations from larger pools. The yield gap, tax advantage, and Bitcoin exposure mechanics force these reallocations over time as legacy mandates break down. Think about it. Just 10 billion in net demand equals 100 million Strife shares issued. That's still less than 20% of Strategy's Bitcoin stack at current prices. In other words, Strategy can scale Strife issuance 10x from today without diluting its Bitcoin fortress by more than a pinky toe. The inflow dynamic is reflexive and self-accelerating. More demand tightens spreads, price goes up, cost of capital drops, index inclusion plus ETF mandates follow. Strategy prints more Strife and buys more Bitcoin. The coverage ratio goes up and yield to risk improves. And yield-seeking allocators increase their position size. That's a monetized Bitcoin flywheel with a 10% throttle. Strife is not a bet on Bitcoin going to the moon. It's a bet on the bond market continuing to suck. And that's not a thesis. That's a near universal consensus. In a zero duration, structurally appreciating, tax advantaged, Bitcoin collateralized yield instrument, everything is asymmetric. If Bitcoin flatlines, you win. If Bitcoin rips, you win big. If Bitcoin dies, you still recover more than a CCC bondholder. And if Strategy skips a payment, your yield goes parabolic. Strife is a weapon of financial reconstruction. A sovereign-grade Bitcoin-wrapped credit instrument that scalps yield from melting fiat pipes and redistributes it to the first investors smart enough to read a balance sheet. The next bond cycle will be remembered for two things: the implosion of fake credit and the rise of Bitcoin-backed cash flow machines. Strife is the prototype. At this point, if you're still thinking in terms of bond versus equity, you're using the wrong lens. Strife is neither. It's a new species of financial instrument born at the intersection of three broken paradigms. You're getting the coupon of a junk bond, the seniority of preferred equity, and the upside torque of a Bitcoin ETF without custody risk, rehypothecation, or redemption timelines. Strife doesn't return capital like a bond, it monetizes capital like an equity. But instead of promising growth, it rents out Bitcoin monetization itself in perpetual yield form. This is monetary alchemy. It turns Bitcoin upside into steady cash flow. It traps value in a capital structure where the investor gets paid forever and the issuer keeps accumulating the hard asset. It destroys duration risk, repels reinvestment risk, and defangs inflation risk all in one move. Strife is the first preferred equity security in history that gets stronger the more it's printed, because every new issuance increases Bitcoin coverage and buys more monetary sovereignty for the issuer. So let's zoom all the way out. The fixed income world has been living on borrowed time, pun intended. Bonds have become zombie instruments, locked in nominal yields that don't beat inflation, durations that amplify risk, issuers with weakening collateral bases, and governments that dilute at will. Strife marks the end of the old regime. The coupon source for legacy bonds are fiat cash flows that are inflationary. For Strife, it's a Bitcoin-backed treasury that's deflationary. The reinvestment risk in legacy bonds is high. In Strife, it's zero. The duration risk with legacy bonds is embedded in the curve. With Strife, it's none. The asset coverage in legacy bonds is weak and eroding. With Strife, it's expanding with Bitcoin buys. The collateral in legacy bonds is leverage dependent, and with Strife, it's scarcity encoded. For taxation, legacy bonds are taxed like ordinary income, and Strife are taxed like qualified dividend income. And the institutional role of legacy bonds is mandatory allocation. For Strife, it's philosophical awakening. Strife is a philosophical affront to the entire concept of fiat-denominated credit. It says yield must be earned from scarce collateral, not decreed by a central bank. It forces pensions, insurers, family offices, and credit allocators to confront an uncomfortable truth. Why am I lending to governments and corporations who destroy value when I can lend to one that stores it in Bitcoin and pays me to watch it grow? The final word is that Strife is the first yield instrument with a thermodynamic bias, a self-hedging credit primitive built for the collapse of fiat credit worthiness, and a hard money siphon that offers yield with no yield curve, spread with no fragility, and an upside with no dilution. This is the beginning of a structural reallocation event. Every time the Fed cuts rates, Strife looks better. Every time inflation lingers, Strife yields more in real terms. And every time Michael Saylor buys more Bitcoin, Strife becomes more over-collateralized. If you believe that yield should be real, that money should be scarce, that capital should be honored, then Strife is not just the best fixed income instrument in the world, it's the only one that makes sense.